Ever wanted to know how professionals find perfect entry points? Today you'll get a trading strategy and a ready-to-use template that reveals where and when smart money enters positions. SMC and volume analysis work on any market, and you don't need years of experience to use it. Let's get straight to practice. The chart template link is in the video description. Go to Templates, click Settings at the bottom, and then Import. Load the ready-made template into ADIS and add it to Favorites. Now you have a footprint chart on your screen. The main column shows bids and asks. The smaller one shows delta. Can't remember what's what? Here's a trick that always works. Bad. Bids, asks, delta. Left to right. That's the right order. Now, let's talk about entry conditions. Our strategy requires that the entry candle meets 4 conditions. First condition, the candle closes as positive or negative. We've already covered this in our SMC videos series, but we'll remind you how it works. Second condition, delta direction. It's simple. A green number indicates buyer dominance. A red number indicates seller control. For longs, you need a significant positive bias like plus 1355. For shorts, you need a substantial negative delta like minus 1678. Third condition, VPOC, this white rectangle with peak trading volume. For longs, your candle must close above it. For shorts, below it, no exceptions. Fourth condition, absorption. Don't worry, we won't delve into complex theory, which you can study in our training marathons. We'll explain it simply. Large absorptions appear as green diamonds at the bottom of candles or red diamonds at the top. You can also detect absorptions by looking at the delta column. For long entries, look for negative delta values at the bottom, minus 300 and minus 170. This is where retail traders were aggressively selling at market, while smart money was filling their limit orders. For short entries, we look for positive delta values at the top, plus 85, plus 244, plus 437 and others. Here, retail traders are buying up sell limit orders, while institutional players are unloading positions. And remember, missed even one of the 4 conditions. The trade is canceled. No debates, no exceptions. And a small bonus, conditions that improve your chances. Imbalances. Green numbers scattered across the footprint show an explosive uptrend. Red numbers, for shorts, show aggressive selling pressure. Zeros at extremes. For longs, a 0 at the very bottom is relevant, like 5x0. For shorts, a 0 at the top. Feeling overwhelmed? Don't worry. We'll now analyze live examples. You'll also learn in which zones to look for an entry point and in which to skip a suitable candle. Look at this red candle. Most traders see bearish sentiment, right? But following SMC principles, we look at where it closes, far above the 50% midpoint. Institutional players see this as a positive candle. Buyers controlled the situation despite the red color. They pushed the price up and maintained their positions. Now, check this green one. Looks bullish, but it closed in the lower half. This is a negative candle. Sellers dominated, pushing the price down. The green color is misleading, but the internal structure reveals the truth. Don't just look at the color. Draw a line at 50% between high and low, and remember which way the candle is structured. Closing above 50%, positive candle regardless of color. Closing below 50%, negative candle, even if it's green. The closing price always tells the truth. But here's what's critically important. Never trade based on this condition alone. First, find a zone where price might react. Then use the template to confirm that institutions are actually responding. When you see all conditions at the expected level, it means the big players are on your side. So, which zones should we focus on when trading? Let me show you something game-changing. If you know how institutional players capture liquidity, you know exactly which zone to look for entry points. See this double bottom? Most traders think, support will hold. Price tested this level twice and couldn't break through. Then they go long. What do we see? A liquidity trap ready to spring. Don't immediately trade on a double bottom, let's observe. Smart money thinks differently. They don't respect support levels. They hunt them. When large players need to enter a long position with huge volume, where do they go? Right where retail traders have their stop losses or are entering shorts. Below this double bottom lies a gold mine of liquidity. These patterns repeat everywhere: double tops, triple bottoms, daily and weekly highs, extremes of European or Asian sessions. These are common and obvious patterns where liquidity is most predictable. Watch what happens when price breaks through this double bottom. This downward spike isn't a natural price movement, but an institutional trap. Smart money triggers every stop loss, grabs all the liquidity, then instantly returns price back up. Retail traders get burned while the big players fill their positions at perfect prices. Now let's switch to 5-minute charts for precise timing. Find patterns on 15-minute charts, execute on 5-minute charts. Here's the perfect formula. Here's our entry candle after the liquidity sweep. It meets all conditions. Positive candle, closes well above 50%, regardless of color. Delta shows plunged in 51, buyers dominated. Closed above VPOC, buyers broke through volume. See the -17 in the footprint? Sellers absorbed. And a bonus, 4 green imbalance numbers, explosive upward acceleration. 0 at the bottom, completed auction. All 6 conditions aligned. Enter long, place stop just below the sweep low, target 2.1. Beautiful, isn't it? The key to success? Start thinking like a liquidity hunter. When you see price approaching obvious levels, think not only about support and resistance, but also about stop-loss clusters. When this double top formed, price was in rotation. As soon as you recognize a double top, draw a horizontal line, switch to the 5-minute time frame, and wait. This candle swept the liquidity, triggering stop losses even above this significant high. Institutional investors filled their short positions. Notice the diamonds indicating massive absorption, as well as the delta values of +347 and +320, extremely high positive numbers. Would smart money open long positions in this situation? Definitely not. Instead, this green delta indicates liquidity absorption. Let's check our trading setup. Negative candle, negative delta, close below POC, 0 at the high, red imbalances everywhere. All conditions for a short entry are met. Enter short at the close of this candle, place a stop 1 tick above the range high, and ride the distribution phase with smart money as they push their newly filled short positions. This isn't an evil conspiracy by institutions. It's just business efficiency. Predictable retail behavior creates concentrated pools of orders exactly where they need them. Another way to trade our setup is to watch for changes in market structure. This is your classic compass for finding entry points. Stick to multi-time frame analysis. Read structure on 15-minute charts. Execute on 5-minute to filter out noise. The concept is simple. Uptrends create higher highs and higher lows. Downtrends create lower highs and lower lows. But here's the game changer. You need to notice when control shifts. The magical moment, change of character. When an uptrend drops below a previous high or low, or a downtrend rises above a previous lower high, control has just shifted. Most traders completely miss this and continue fighting the old direction. Perfect example here. A beautiful series of higher lows confirms the strength of an uptrend. Then, boom, this candle closes below the previous low. That's a change of character. From this moment, stop hunting for longs and start looking for shorts. What happens next? Price retraces to retest the broken level. Old support becomes new resistance. This is your entry zone. Large players use this pullback to build positions, while retail provides liquidity. Let's analyze these 5-minute candles one by one. This one closes above 50% despite negative delta, not our entry. This one closes negative but has positive delta, disqualified. These two have positive delta, we skip them. This one has negative delta and closed negative, but closed above VPOC, mandatory condition failed. And here it is, negative candle, negative delta, close below VPOC, absorption above the level. This is our short entry. Stop 1 tick above, and we move with the new downtrend. This works both on reversals and continuations. After the change of character breaks the high, switch to the 5-minute and wait for a pullback. Previous resistance becomes new support. The template confirms institutional absorption during the pullback, indicating continuation of the move. Another perfect candle, all 6 conditions aligned for a long. But wait, we got stopped out. Don't panic, this is liquidity sweep in action. Smart money returned to the area, created more absorptions and extreme delta. This was necessary to build strength for the real move. Move to the sweep candle. All conditions are met, plus confirmed liquidity sweep. The initial shakeout just loaded more spring into the explosive rise. Still sounds complicated? Then watch our video, Smart Money, Market Structure, and Liquidity. Your next clue for entry is fair value gaps, which act literally as price magnets. Once you start noticing them, they'll work in your favor. Look at this 15-minute chart. Here, price creates aggressive sequences of 3 candles. The first candle ends here, the third candle starts at the top, and the middle candle shot upward. The market moved so fast that it skipped price levels, leaving this gap behind. This gap acts as a future magnet for price. Why? Because large players create gaps through urgent entries or exits. Few transactions occurred in this area, leaving unfilled orders and unsatisfied demand. Let's switch to the 5-minute chart to see the magic. When price returns to test these ETH look for entry conditions right at the boundaries. The larger the gap, the higher your chances. And the best setup is when a fair value gap aligns with the structural levels we discussed earlier. Let's find the perfect entry point. See this green candle? Looks like a signal, right? But it closed below its midpoint. This is actually a negative candle despite its color. But this next candle fulfilled all 6 conditions, and with it, we could move long following smart money. And finally, you can easily use this strategy with order blocks. They precisely reveal where big money entered positions. These aren't single levels, they're entire zones where institutions systematically close old positions and enter new ones in the opposite direction. Why are these extensive zones? Because large players cannot dump huge positions through single transactions without shifting price against their interests. They methodically return to necessary price levels, creating clear footprints. Here's the system for hunting order blocks. Use only 15-minute charts or higher to eliminate noise and false signals. Look for them at swing extremes, swing highs for bearish blocks, swing lows for bullish blocks. Watch how price gradually decreases into this swing low formation. For bullish order blocks, find the final negative candle in this area. It's either the candle with the lowest low or the one before it. This candle represents pure seller dominance before the institutional reversal. But you need confirmation. Look for structural confirmation through change of character or break of structure after the order block forms. Here's our break of structure, confirming the shift from bearish to bullish control. The second confirmation is a fair value gap, immediately following the order block and extending beyond its boundaries. This FVG shows institutional urgency and strength, creating momentum. Both confirmations present, then you've found the perfect order block. Now switch to the 5-minute chart and patiently wait for the final retest. When price returns to test the block, apply the conditions for finding the candle. Notice how price deviates from this zone during retesting. Here's our entry candle, because all mandatory conditions and one bonus condition are fulfilled. But we got stopped out? That's liquidity sweep in action. The institutions decided to return to the order block, dip deeper, and shake out retail longs like us. We discussed this concept at the beginning, so it's just an additional reason to look for a new entry point. Obviously, smart money is working. This green candle may look tempting, but remember, color lies. Using Fibonacci, we see it closes below 50% of its height. This is actually a negative candle. The next candle gives us another chance to enter the market. 5 conditions aligned, and even without the 6th, it's obvious that institutions captured additional liquidity for the move. Second tests often reveal final absorption before explosive movement. After liquidity sweep, you'll also get stronger order blocks, which is why we recommend using this strategy fully, accounting for all market situations. Look at this stretched candle, clear evidence of liquidity sweep with absorptions in the shadow. It satisfies all order block criteria. We mark this zone with a rectangle on the 15-minute chart and wait patiently. Institutional reactions don't follow intraday trading rules. They unfold over days or weeks, waiting for optimal conditions. After more than a week of waiting, boom! Notice how the VPOC on this candle perfectly aligns with our order block boundary. This isn't coincidence. It's recognition of the exact price level where large players' positions remain active. The next candle becomes our setup for entry. Patience when trading with delayed order blocks really pays off. When smart money is finally ready to act, the market's reaction often exceeds retail investors' expectations, as accumulated institutional interest has created truly strong momentum. That's it. Time to put the setup to work and follow the institutional wave. And don't forget to download the template in the description. It's your advantage, even if you're going to partially supplement your strategy with it. Hit subscribe if this opened your eyes to how institutions really move markets, and check out our other videos on advanced analysis.